Hello and welcome to Contemporary Living, where we provide lifestyle solutions for everyday people. We are just so glad that you decided to join us today and taking time out of your weekend. I know the Bears are playing. However, for those of you that are with us and watching, we thank you. We know football season is underway, right, Andre?
Yes, we have a lot of competition, some stiff competition for the next few months, but we're up for the challenge. But we are excited about today's show. We have a great guest with us today. We're going to talk about some finances and money today.
Right, run those housekeeping notes.
Yes, all right. Let me run these housekeeping notes before we even get started, all right? So let me go ahead and add this here. So just to let you know, thank you, like we said before, for tuning in to Contemporary Living, where we provide lifestyle solutions for everyday people. Just to let you know, if you want to be on our show, if you want to be a guest, if you want to, if you have a commercial that you want us to air for you, please send us an email at farminghill@gmail.com. Also, if you're on Facebook right now, if you're streaming live on Facebook, please share our content and like us on Facebook. You can find my wife each and every day on Facebook, putting up inspirational posts as well. And then if you're on YouTube right now watching Contemporary Living with Farming Hill, please subscribe to our channel and share this video today. And last but not least, if you're on the E360, well, if you're on Roku, if you're on Amazon Fire, if you have Apple Television, if you have an Android, if you have an iPhone, please download the E360 app. We come on each and every other Sunday at 8 p.m. Central Standard Time as well. And just to let you know, if you're in the Chicagoland area, we come on Comcast each and every Thursday night at 9 p.m. Central Standard Time, where we provide lifestyle solutions for everyday people. So we appreciate you guys for tuning in with us tonight. We thank you so much. And like I said, we on Comcast each and every Thursday night, 8 p.m. Central Standard Time in the Chicago South suburbs and Northwest Indiana as well.
Awesome. So one of the things I just wanted to mention yesterday was a monumental day. It was the 20th anniversary of the terrorist attacks that happened on American soil, 9/11, 2001, New York, the Pentagon, Pennsylvania. So we took time out to remember that event, that significant emotional event where in the end all Americans came together. We came together as a country, and yesterday marked the 20th year that that event happened. So I just didn't want to bypass this weekend without mentioning that. But what I want to do now, Andre, is bring in our guests.
Yes, but before you even bring in
What you
our
got?
guests, and just to let you know, Melissa, she put together a nice event for 9/11 yesterday. I'll post up the pictures on Facebook later tonight. I also put up the video as well, so you can take a look at the ceremony that she put together. It was a very emotional event. People came out and supported this event, so we thank God for the men and women
Yes.
that served. We thank God for our firefighters, our police department,
Front line.
and of course, our heart goes out to those that lost their family members in 9/11 as well. So thank you guys so much. So go ahead, Melissa. I mean to interrupt you there, but
That's okay. It was for a worthy cause, but I want to get right into it.
yeah.
So tonight's guest, I know we've been talking about real estate lately, and tonight is no different. But we're going to take a different spin. We have a loan officer on board, a Marine.
A Marine.
A Marine.
We got a Marine.
Absolutely. Loan officer. So Kevin Mitchell, he's a native of Northern California. He was raised always playing sports and was known for being the kid that had a passion for analyzing anything and everything that interested him. So the funny part is Kevin's probably a natural born loan officer, because that's what you do. That's what loan officers do. He has been a U.S. Marine for almost 16 years. Okay, I got to give you the Army hook. And continues to serve. So not only is he a loan officer, you guys, he is dynamic. He is also serving as a U.S. Marine. While serving, he took advantage of educational opportunities and studied applied economics and business at Penn State. That's that East Coast love. Penn State.
Yes, yes.
If we're talking about the same Penn State, we'll find out when we talk about
right.
Right? So while serving, he has expanded his servitude to veterans and homeowners alike through his dedication of being a practitioner in the mortgage lending world. He continues to refine his knowledge and always shares meaningful insights and to our community. Ladies and gentlemen, get ready for the passionate, and I call him celebrity, because you need to follow him on Facebook.
Yes, yes, please.
Loan officer, wait a minute, and Marine, Mr. Kevin Mitchell.
Kevin, welcome.
How y'all doing, Andre? How y'all doing?
Hey, we doing good, celebrity.
Great to see you guys. Great to see you guys.
Yes, thank you. We've been trying to get you on for a minute tonight. We know you got some resources and information for us. Thank you so much for tuning in tonight. Yes. So Kevin, hey, we're gonna jump right into it because we got a lot of questions for you. First of all, I gotta thank you for your service. Now tell us how many more years you're gonna serve, and also give us some idea of some of the locations you've been to. Where all have you traveled since you've been in the military?
Oh man, so yeah, there's a pretty strong chance I'll retire. I mean, business is doing well with being a loan officer, but there's something to be said about reaching all the way to retirement. And oh man, where I've been. I have been to over a couple dozen different countries and locations. Southeast Asia being my favorite, just because of the beautiful waters. I love to scuba dive and snorkel and spearfish. So being in Southeast Asia has always been my favorite area to be. So everywhere from Southeast Asia, Middle East, everywhere you can pretty much think of that we go, I've been able to visit in some capacity. So it's been a very amazing journey and an amazing trip up to this point.
Nice.
I definitely can relate. By the time I retired, I had about maybe 14 different moves in 18 different locations over a 20-year span. So every
Okay.
year and a half to 2 years I was gone somewhere. And then of course with the deployments and all of that, it's just wild. Yeah. But my favorite
Yeah.
place was Germany, where I spent 5.5 years. So I absolutely love it over there. And we're planning on getting back there one day. Yeah.
Yeah, she said I have to go to Germany. She
Yeah,
said
yeah.
I have to go. I have to go visit.
Nice,
I
nice.
want to I want to start off by asking you what is, because we can't take for granted that people know. So what is a loan officer and how do I find a good one like you?
Yes.
Oh man. So just like I'll start with the what we are is bottom line is we're professionals that are licensed, right, in either nationally, if you work for like normal banks like Chase or Wells Fargo, etc., they are able to do loans anywhere because they work for what's called depository institutions, right? They're the generalized scope of a loan officer in terms of their 9 to 5. They work in specific parameters. A little bit more limited. They don't have as much of a capacity to do loans in a broad scope, right? They're
Mhm.
usually very refined in a niche, and typically those guys are going to be the ones that are doing like your really high dollar loans, like $8, $9, $10 million,
Mhm.
those type of areas. And then you have loan officers that work for either retail lenders or brokers, right?
Right.
Your retail folks are places like Guaranteed Rate, Rocket, Veterans United, those kind of institutions. Um, I've worked for both a retail shop and now am a broker, and I can say I will never leave the broker channel so
Mm.
long as I practice as a loan originator. It's just far and away a much more suitable and facilitative capacity to serve people that need lending, right?
Yes.
As long as you're doing your job and maintaining yourself as a practitioner, as a broker, you're going to always have the cutting edge because you have so much more capacity to take care of clients, whether it's lower credit scores, higher dollar amounts, different property types, different terms, et cetera, et cetera. We have the ability to do a lot more refined, um, tailoring for the client, right?
Mhm.
So, but for a loan officer, when someone's looking for a home, right, they always want to go to a loan officer first,
Right.
get qualified, right? Because we get you set up with your finances. We talk to you about your qualifications. We can help guide you on if there's anything with credit you need to touch up on, what you can or can't do, what you should do, what the best recommendation based on all your needs are,
Mhm.
right? All the things that you're looking to do, right? And sometimes we're able to get you, ready to go right away. You're set. You've done just done your job already. You
Yes.
get set for that. Sometimes we take a few months. We got to, refine some things with credit, or pay some things off, or do some other things, whatever the case is, or save a few more dollars.
Mhm.
But we can set you up for that too. And if you get a really good loan officer, they're going to be able to do more for you beforehand, other than just the financial aspect as well. Talking about, what if you qualify for, say, only FHA, or you're specifically looking for VA, right? We could
Mhm.
talk about, what the issues may arise are in the market you're going to go to, right? So we could talk to any appraisal issues, or talk to any delays in things, or how the appraisal process can be handled for VA, because
Right.
it's by far and away the
Right.
best appraisal process out there for any product.
You
Um,
you you mentioned about being qualified. What documentations would someone need to present to you to get qualified for a loan or pre-approved?
So it really breaks down pretty easy. It's what we need to see is any documentation that relates to income, assets, and a review of your credit.
Mm-hmm.
So if we can review those three things in depth, then we can give a very good, solid pre-approval for you when you go shopping, and worry a lot less about the possibility of falling out of escrow when you get in contract. The challenging ones coming on board for pre-qualification are going to be people that are like self-employed or
Yeah.
1099. It takes a few more minutes of time. I say that kind of lightly. It's it may take a couple hours or so extra or day to get that situated to be certain on the qualification, because there's extra steps we got to take when we're looking at income for self-employed or 1099 borrowers. But it
Mm-hmm.
really breaks down to those three categories. As long as we can verify with documents those three things, there's a very strong possibility that the pre-approval that's given will be just as strong as you are at the finish line.
Right.
Okay.
So yeah. So y'all pretty much would need maybe what the last 2 months of bank statements, employment information, as far as income, and like you said, any assets as well. Any particular credit score that our viewers will need as well.
So going back to the perks of working with a broker, there is lenders that we could use that will go down to, say 500 credit scores for FHA or VA.
Mm-hmm.
The process when you go that low on scores with those lenders, it is going to take a little more time. It is a little more tedious because now we have to kind of build a stronger profile for that client in other areas, since the FICO score is not so strong. So maybe lots of reserves or money in a bank, and so forth can help. It's not a determining factor, but it can help.
Right.
Because what happens is anytime where you've got a 500 credit score or 720 credit score,
Mm-hmm.
whatever the loan you're looking to do and the way we're structuring the file all gets run through a system called AUS, Automated Underwriting System. It is the system that analyzes the profile that you put together, the structure of that file.
Yes.
For that client, that includes all of those things that I mentioned for documents, the incomes, the assets, the credit. And so when you put numbers in the system, in the file, this is why having those documents is vital in that initial time period, because it proves the accuracy in the numbers that you put on the file. And that way you're not getting a false positive when you run AUS. And when AUS looks at it, they're going to look at it from a risk factor perspective for your entire scope as a borrower. And if you have, one or two negative factors, but you have a few really positive, strong factors, right, that can help offset the risk factors and improve the chances of getting what's called a prove eligible, which is the best, rating you get back with AUS, and that's what you want to get.
Right.
Because if you get a lower than that, then you're kind of running into more challenges, and we start stacking the hurdles even more. But yeah, it's very simple. The income is typically just, if it's say a W-2, say it's a military veteran or a current active duty, it's just your current LES that covers that last 30-day period. Any bank statements that you have for the last 60 days, and then if you want to include TSP, any 401ks or IRAs or other investments that you hold value in, that can help. Now, if they're looking for VA, there's not going to be the possibility of appraisal waivers. But if you're looking at doing conventional, whether it's a purchase or refinance, depending on a few other factors, not besides the assets, showing more assets can be one benefit to that file for conventional that can help improve the possibility of having appraisal waivers. So that's another one of those like hidden reasons that, a lot of borrowers don't know, and even a lot of loan officers don't know, that you could use to help the client along and get, an improvement. Because if you get an appraisal waiver, you're knocking, 7 to 12, 14 days off the loan process and saving the client anywhere from $500 to $1,000. So
Yeah.
by just showing more assets or, more income or what have you. And there's a couple other factors that are involved with the appraisal waiver, but which is like
But
if the
that's
property wasn't appraised in the last 5 years, then it's not going to have one. But besides that, the emphasis on the documents is there.
Okay. So we talked about income, assets, and the review of the credit. So, to get someone qualified. So you've covered that. That was very good. That's some very good information. So now, once you do that, what types of loans are out there just for everyday people? Is it just one type of loan? Because people they know they want a house.
Yes.
But they don't know what type of loans that are out there that they may qualify for. And also, are you only a loan officer to support veterans? Just, that part too.
Yeah, so there's probably a good couple dozen loan programs.
See, I had no idea.
Close to. Depending on how many variables you want to spin into
Yeah.
the program, what you call the program.
Yeah.
But besides the four agency main ones, the Freddie, Fannie,
Right.
conventional, but they're two different entities and they have different guidelines. Freddie is actually more forgiving on the conventional side when it comes to meeting, say, like reserves for investment properties, or reserves if you have, lower scores or whatnot have you. They're more forgiving.
Yeah.
And VA is the straightforward, either active or veteran or surviving spouse, right? And you're just looking for a zero down option because you qualify to use VA. And actually, there is, so if you are, there's another way of getting a VA besides being a veteran. And that could be, we can touch on that in a little bit later here, but it's something I think would be good to touch on because it has to do with some medical professionals out there as well. But yeah, so the VA, right, and then you have FHA, which is similar to VA in guidelines in some regards, but it is, the next best thing to VA for people that cannot qualify for, say, conventional, for whatever reason that they can't qualify for it. Stuff like, bankruptcies only need to be can be seasoned for less time.
Right.
FICO score, so it's more forgiving. Better on the documentation side in terms of assets and stuff like that. So it's got a little more forgiveness to it. The trade-off is, you have upfront mortgage insurance premium rolled in. You could pay it or you could finance it in the beginning. Right. So it's kind of like a VA loan, how the VA funding fee could be financed into the loan, but the closing costs need to be paid. And there's a multitude of ways those could get paid, but the FHA is similar in that regards. The upfront mortgage insurance premium is the 1.75%, and then you pay a monthly premium in addition. It's not all that expensive. Depending on multiple factors is what's going to determine that. So it's really one of those things that you got to plug into the system with a loan officer to actually see it. And then USDA. So USDA is more or less for like agricultural land, rural areas, that sort of thing. Those are the primary uses of the USDA. But aside from those, there is a whole world of what's called non-QM or non-qualified mortgage, which means the mortgage product that you're looking at cannot be sold to any of the agencies, right? Cannot be backed by any of the investors that are investing in those mortgage-backed securities. So the non-QM would be like, let's say you want to buy an investment property, right? And you still have to put 25% down for an investment property conventional, right? And the same say what's called a DSCR loan, which is a non-QM product, and that's a debt service coverage ratio product. It basically qualifies the loan off of the property's ability to produce income, and the qualification is exactly in the name. It's a coverage ratio qualification. So you've got $1,500 coming in for rents and $1,000 for the mortgage, right? 1,500 divided by 1,000 is only 1.5. So your ratio is 1.5, which is high, and it's right in the good spot of where you want to be. Now, there's lenders that will do those DSCR products down to like 1.0 or less even.
Wow.
Which technically, yes, the person may be losing money on cash flow, but maybe there's something in mind that they have otherwise. But the point is, they don't have to produce any employment or income, right, documentation to show anything of that nature. It qualifies solely on the property.
Oh, wow.
Or say no ratio loans, which is the same. You don't have to show, any income or employment for no ratio loans. It's 25% down typically. Your trade-off is the rate is a tad higher than conventional, but your trade-off there is, if say you're newly self-employed or 1099 and you don't make as much on taxes, because taxes and 1099 and self-employed, we base your income how we calculate things on taxes,
right,
plus P&Ls. So people like that can take advantage of a no ratio loan where you put more down because you got the capital and your rate's a little higher. And then once you're established self-employed borrower with 2 years or whatever, and you can take advantage of conventional, you can go to that if it makes sense financially to drop that rate to a conventional product.
Wow.
Two of them that are very, very good to use, very under the radar. Not a lot of people know about them. And there's like self-employed loans that are anywhere from bank statements that are like 12 months or 6 months or even 2 months of bank statements for self-employed, which almost all the public I've known and interacted with believes that you need 2 years of taxes or 2 years of history self-employed, when if you've got a broker in your freaking tool bag that's got some experience, that understands investors, that understands the non-QM, they could pull all these tricks out of the hat. But the bottom line is, like, there is very, very few people out there that truly cannot get qualified on a loan. It's
that
just a matter of evaluating everything about that borrower's profile and taking
man.
Right? So
that's amazing.
Those are the products that are fantastic to reach for if you've got those borrowers that, hey, I'm not your average Joe. I don't fit in that cookie cutter borrower range. I'm like, okay, we got to go look at those non-QM products and see what we could do for you.
Yeah. Oh, wow.
So that's why I was going to say, that's why we have you on the show.
Man, some valuable information.
The depth and the breadth of the knowledge that you have. Like, this is the first time I've ever even heard of self-employed loans.
Yes. Only thing I have heard of conventional FHA, VA, the 203K. Yeah, right. But this is some good stuff. Now, let me ask you this, Kevin. Far as grants, first-time home buyer grants, what do people need to do to qualify for those? Do they need a certain credit score or what for grants?
So grants are typically a municipal level thing. So they'll be like city, county, or state level sometimes.
Okay.
And depending on where you want to go, right, is where you're going to want to search. So if you know you're going to want to move to, say, Okaloosa County, Florida, you'd want to specifically look at Okaloosa County, Florida, and look on their web pages to find in their municipal sites anything that offers grants for mortgages or first-time home buyers or veterans or tax benefits. So a lot of states will allow for veterans to forego either part or whole taxes on property taxes if they're disabled veterans,
Yeah.
And they all have different parameters in a whole plethora of scopes. So it's really going to come down to if the borrower wants to look at adding grants to the situation, right, they've got to convey that to the loan officer early on, because the loan officer will know, right, as long as you picked a good one, will know where to go to find those grants and how and if they can apply to you, whether it's for, VA or veteran or what have you, or first-time home buyers, right? They can locate those programs for you and then be able to apply them. Sometimes the borrower has a hard time, right, finding those programs, because we all know municipal sites are not always the easiest to navigate. So, but with a well-versed loan officer, they'll be able to locate those grants for you. So,
have you worked with nonprofits before, as far as those looking for buildings and stuff like that, houses, like the nonprofit organizations?
I haven't worked with nonprofit organizations in a sense of being the loan officer involved in that capacity. I've worked with nonprofit organizations in terms of discussions and administrative, feedback back and forth, and providing guidance to them on, say, like guidelines or veteran specific things, whether it's lending specific stuff for veterans or if it's specific stuff that's pertinent to veterans in general, as a veteran would apply, whether it's like how they cope with things or how things happen with the services and the transition out of the services and the challenges they may face when they get out, and the realities of things and a lot of the mental struggles that occur that don't get realized until the minute you walk out that gate and people are leaving. It's like a wave front hits them a lot of times, and a lot of them get that nostalgic moment, right? If I miss it, and it starts compounding through everything else. It becomes a ripple effect on just decisions in life in general. But that kind of thing is more along the lines of where I've dealt with nonprofit organizations.
But did you have a question before we go to commercial?
Well, I know we're going to go to commercial, but I'm going to dig into your personal opinion. So we know right now from, all the other people that we've talked to that it's a seller's market.
Indeed.
So it's a seller's market right now. So what is your opinion of people who are purchasing homes way above asking price? Because it's like a price war. And what do you think by doing this right now? What impact do you think it's going to have on the housing market?
Oh man. So part of that depends on how long this continues.
Yeah.
It's a very disruptive factor compared to the platform of real estate historically, typically seen where increases in values were driven by more or less false underlyings, and that FOMO effect, the fear of missing out,
right?
Because people were coming in and they were things were selling so fast. And we have a little bit of that now, but what we've gotten now was people being able to come in with all this extra money, and being able to pull money out of huge retirement accounts, right, because of COVID, and having different guidelines applied to those accounts that are beneficial for them to use them to do this, right? So we have a sort of weird, unprecedented situation, and
right, because it's not like 2008.
No, 2008 that is a big topic of largely misunderstood, time frame, and it's not a lot of what people think it really was.
Oh wow!
But the situation right now is, appraisers have a job to do that is, and part of that job to do is to be realistic about things and not overvalue things just because somebody's overpaying for it, and make note of that realization in the form of the metrics and quantitative formulations that they're putting on the appraisals. And you'll see at the bottom of appraisals when you have like the comps, you know, the subject property, and then the three comps in a column with their, you know, square footage, the numbers, and a few other metrics, right? And at the bottom of that, you'll see bars that say gross and net adjustments, right? And those are those adjustments that the appraiser are making for all those other like kind of unforeseen intangible factors. And they're doing their due diligence more often than not. So property that is on the market for $600,000, yes, somebody may come in and pay $700,000 for it. The appraiser is going to come in and still appraise it for $600,000 because, like you said, they're still paying over appraisal and over list price. It doesn't make the home worth more at that point. It takes time for that to truly take effect because more data has to compile for that home to truly be worth that. More homes need to continuously sell for that, but they don't. So those are only one-offs. So if you have more homes that are selling like, you know, 5 to 20,000 over, right, the appraised values are going to only start creeping up to that $15,000, $20,000 amount above where they're currently at, not the random, you know, one-off $100,000 ones. So the realistic nature of things is still being maintained, and the appraisers are using what they've got to use and what they should be using to do the right thing. And that's why you still see appraisals coming in low because there's the realistic factor to this, and then there's the FOMO, which is not a reason for values to skyrocket, right? Because and they take into consideration that we are in a odd, you know, area right now in terms of real estate, and not allowing that to you know, disenfranchise the other factors.
Right. So what we're going to do, we're going to take a commercial break. When we get back, because I told you that time goes quick, we're going to hit on renovation loans for about a couple of minutes, and then the one everybody's waiting to hear about is using a VA loan twice. We're going to talk about that. All right.
Here.
Bias. I always think that Farm Hill commercial that Farm Hill coffee commercial is awesome. But if you want your commercial done on our show, if you want to be a guest on our show, or if you just want to say hi to us, contact us at contemporaryliving22@gmail.com. It's just that easy, guys. That's contemporaryliving22@gmail.com.
And the Farm Hill Coffee is our own brand of coffee that you can purchase on Amazon. I'll make sure that I leave the link below in the comment box as well. You can purchase our coffee on Amazon. The Farm Hill Coffee is a medium roast brand. It's actually selling pretty good. We have 5 stars across the board. So we running short on time. So I'm gonna get Kevin back in here, and we're gonna go ahead and finish this great conversation out. Kevin, you still there?
Sure am.
All right. So Kevin, I'm gonna ask you very quickly because of time.
Sure.
2 things. I'm just put it all together. What states are you licensed in, and also, as far as renovation loans, what type of renovation loans they have out there? Because I know at one time I believe they stopped the renovation loans.
Yeah, they did. That was a call by the VA, and obviously the lenders have to follow suit. As far as licensing, I am actually in 8 different states. I'm in Arizona, California, Florida, North Carolina, Tennessee, Texas, and Virginia.
And we love Florida.
Those are good military states.
Right, we love Florida. Hey, just to let our viewers know, I actually met Kevin through David Pere, I believe that's his name. He has a YouTube station and Facebook station called From Military to Millionaire. And he connected me with Kevin. We kept hearing great things about him. And we appreciate David for connecting us. And ever since then, we've been following Kevin. Ever since then, yeah.
As you can see from the show, I mean, this guy knows his stuff.
Yes. So we'll let him finish about the renovation laws, and then Melissa's going to ask about the VA. Okay. Go ahead, Kevin.
Awesome. Thanks, guys. So the VA renovation loan just recently came back online a few months ago from being under a COVID shutdown, essentially. But the VA renovation loan is a nice loan to use if you find a house that is a little bit, out of tweak, a little outdated and whatnot for you. The big misunderstanding about the VA renovation loan, though, is that it's meant for finding a beat up house that just is, down in the dumps, and you need to come in and wipe things out and rebuild and do all these major things. And the truth is the VA renovation loan does have a decent amount of limitations on it in terms of what can be done. The main thing to understand about the VA renovation loan and the allowable items is if you can't live in the home while the renovations are being done, it's not going to be allowed. And the primary things that it's meant to do is like freshen up a kitchen, freshen up a bathroom, do some changes in a bedroom, freshen up a closet or something. But primarily it is not meant to do is, do full remodels and gutting a home and tearing down walls and so forth.
So more cosmetic.
What's that?
More cosmetic?
Yes, it is primarily cosmetic. Absolutely. So it's one of those things that, if you're going to do it, you got to talk to a loan officer on it. And it's a challenging one to do now because you've got to go through the stuff with the loan officer to kind of identify, I found a property. All right, right on. Let's talk about what you're planning to do and what is actually an issue. Because what sometimes happens is you'll get one and they're like, this is the things I want to do. And I'm like, okay, cool. And it'll say it's built like pre-1978.
Right.
Instantly throws another flag to me because now I need to look at, hey, does it have chipping paint in places and stuff? Because pre-78, you had lead-based paint, and that's a no-go. You got chipping paint with VA. So when someone says, renovation, and it's pre-78, I'm like, okay, well, now I'm on high alert and looking at other things. But yes, like you said, primarily cosmetic. If you need bigger things than that and some major stuff done, the best product to use is actually a Fannie Mae home style renovation loan. And you could do that for as little as 3% down if you're a first-time home buyer and you're looking to get a home.
Right.
It is a conventional product. If you're not a first-time home buyer, it's just 5% down plus closing costs, and then you're off to the races. But that basically allows you to gut the entire place, do major changes, do all kinds of stuff to the home. I mean, you can even add a pool into the property with the home style renovation loan. It's an amazing product. It could even be used on investment properties for 15% down. wink, wink, a lot cheaper than doing 25% down on an investment property that most people try to get into and say, oh, I'm going to get it and then I'm going to put a few bucks into it. Well, if you do a home style renovation loan, you get it for 15% down, right? And the renovation's covered.
Makes sense.
So, but yeah, the renovation loan is fantastic. The other qualifiers are going to be, stuff like the contractor's got to be certified with the VA, which doesn't take very much to do. You could also search for people that are already registered with the VA to do construction because it's a little different process just because of the way the VA handles it. Some GCs, general contractors, don't want to do it because some of them want like a lot of money up front or what have you. So there are some limitations, but that's one of those things. Talk to the loan officer, really get some refined information about it. Talk to somebody that's done it before is the best way to go about it. Because then you're going to get somebody that has already gone through the bumps and bruises of the first couple that they've done. Because it never fails. The first couple a loan officer does for VA renovation or any other renovation loan, unless you're like using another loan officer that has done it and he's like your backstop and constantly feeding you info. I mean, it's going to be a challenge, right? And one little thing missed can cause some very serious issues and delays in the process. So just be mindful of it.
Okay.
Now the pressure's on, Kevin, because you got to answer all of these questions like in 4 minutes. So we don't want our viewers to think you're just all work. So tell us, we understand that you have, high demanding careers. You're a Marine and also you're a loan officer. So how do you manage that work-life balance and then go right into how do you use your VA loan twice?
Yeah.
But we want to hear about that work-life balance because we know that you are not just work.
Right.
Yeah, so it's definitely challenging. So I put in the extra hours with work and stuff in the off hours where I know people are not going to be, my family stuff's not going to be awake, right? So the things that are administrative that I could do that I don't need interaction with supporting staff or personnel or with clients, I do in off hours, like 4:30 to like 6 in the morning and stuff like that. By the time 06 comes around, my East Coast clients and support staff and stuff are up and moving and needing me for things. So I put in the time there, and then in the evening, same time, 8 or 9, so maybe 10 or 11, I'll put in some more time. But usually the administrative stuff doesn't take a huge chunk out of my day because I use support staff that do a phenomenal job. I have loan officer, assistants, and processor and stuff that does a phenomenal job. And I believe in hiring the absolute right individual. Hire slow, fire fast, but pay well.
Right.
It's done very well for me, and that's where I think I've been able to really harness the work-life balance.
So it sounds like you got a team and a system in place.
Yes, absolutely. You cannot have a business and function and scale without that. No matter what you're doing, whether you're a loan officer or a real estate investor or whoever you are, if you're running a business or you're doing anything entrepreneurial or anything that is not a straight up W-2 thing, right? And you want to scale, you've got to have support staff in place. You got to pay them well. You've got to find that place where you are willing and able to, do a pause on your profit margins per se in terms of scaling to bring on and build and gain the momentum of the implementation of that support staff. So it's kind of, you're scaling, boom, support staff, you slow down, and then boom, you overlap, and then you're off to the races again, right? Because your support staff is caught up to where you're at, engineered your capacity, and now you're scaling up to the next tier. Nice. And then for using the VA loan twice, there's a lot of big misconceptions about that. And so I'll run it down to ground in terms of the basics for how you can use it twice. So
yeah, please.
Let's say you own property A and you want to move out of it and buy property B. Now, if you're moving a far distance away, like say over 100 miles, there's no questions about it, right? You could use, that's the first hurdle that you're not going to get hit with, right, is the distance thing.
Right.
Now, the other thing you got to consider is the county loan limit for the oncoming property B, right?
Mhm.
So if you bought, say, a home for property A, you bought for $200,000, and then you're going to go buy property B for, say, $400,000, but the county loan limit where property B is only $548,250.
Mhm.
You see where the total property amounts were $600,000, but that county loan limit was not, right? So
Right.
the difference between the county loan limit and that new property's price that it brings you over the county loan limit, you just got to cover that difference by 25%.
Right.
So that's one way you could cover getting a second one and using your VA loan. I mean, you really only need to have, to use second tier entitlement, the home only needs to be $144,000 and $144,001 to
Mm.
use second tier. So there is a minimum. So that is one thing to consider as well.
Okay.
If you go to buy, say, a property in a place like where I live, where the county loan limit is like $753,000 for a single family,
Mm.
and you previously bought something, say, in Texas for $200,000, right? You would have that, about $553,000 essentially that you could purchase a home with zero down. Well, on your second tier, because the county loan limit here is higher.
Mm.
Right? Now, let's say you want to take it a step further. You're like, well, I just keep moving to all these inexpensive locations, and every place I move to, I can get a home for $150,000.
Right.
You can keep getting a home for $150,000 until you've run up to that county loan limit.
And they're going to count the income from those property A when you get property B.
So when you move to property B, you're not going to count the full income in terms of like paying off the debts, right?
Mm-hmm.
Or discounting them. On VA, let's say you're moving out of property A into property B.
Okay.
You'll actually be able to disregard or omit the debt service on property A for the qualification on property B because it's a departing residence.
Right.
Right. And so that is a huge benefit. Now, if you get where, like I was saying, you're like, oh, well, I keep buying 150K homes, and you end up with the third one, and let's say property A has now been on 2 years of taxes. Now we calculate that differently, and we have to look at your Schedule E on your tax returns to calculate whether you have a net positive or a net loss. So those are a couple of different things that people aren't quite tracking on when it comes to that. And then if you do buy, let's say you have two properties, you haven't hit the county loan limit yet, but you're like, I want to buy a third with my VA loan. If you have not refinanced either two of those other properties and done a reinstatement on your VA entitlement for either one of those, you can refinance both of those properties, reinstate your VA entitlement so it removes the VA, right, the entitlement off your certificate eligibility for those first two, right, and it resets the clock and eligibility on your COE, your certificate eligibility. Now, when you go to buy property 3 with a VA loan, you could do it as long as you refinance it into a conventional or some other product besides VA.
Right.
Or sell them. You could also sell them. Now, if you were to say, okay, well, now I want to go buy a fourth property with a VA loan, you would have to relinquish those other 3 properties or 2 if you only did it with one. Let's say you bought your first home that was like almost right up to the limit of, the county loan limit. And so there's no way second tier entitlement would cover property number 2 purchase, right? And neither would the difference. So you refinance that into conventional, reinstate your loan or your entitlement to your VA, buy property B again. In that situation, if you were to go buy a third after that third one would require you to actually to sell those first 2 properties, right? Because you've already reinstated your VA and you're still holding those properties.
And then, do I have to be a veteran in order to get a VA loan?
So predominantly, yes, in terms of either active or veteran or surviving spouse. Now, it's going to take a little more explaining for the other qualification.
Okay.
So if individuals would like to discuss that part, They're welcome to contact me on Facebook. I'm easy to find. Just look up Kevin Mitchell Nexa Mortgage. You can't miss it. It'll be there, should be there right at the top. Or you could Google search my phone number. I pop up right at the top, as well as 562-445-2971. And we can discuss that. But yeah, it is.
And I will provide those links as well.
Yeah.
Yep.
Yeah, absolutely. Would you like me to drop the links into the comment section here?
Yeah, you can. Yeah, I got it. You know what? I added to the stream, and I also have it strolling at the bottom here.
It's on the ticker now.
It's on the ticker now. So yeah, people can see it as well. And then I added to the stream so people can see it as well once it posts. But I have all your information here. Awesome. So yeah, so we definitely appreciate it. Now,
Kevin, you are a great American. Thank you for all that you do.
Now, Kevin, you have a wife and kids, correct?
Yep. Yeah, we got a wife and 2 kiddos.
14.
Awesome. Yes, we appreciate them letting us steal your time tonight.
Especially on Sunday.
Yes. We've been trying to get you on for a minute, man. This is the wealth of knowledge. Yeah, so man, I know who to be calling definitely from now on. Yeah, so we definitely appreciate you for stopping by. We thank you so much. And Kevin, so where in 1 minute, tell us where you see yourself in 5 years, 5 to 10 years from now. I got 1 minute.
Boy, in 5 years, I will absolutely have my own brokerage, which long story about how it's going to be set up, but it is going to be something else. I can tell you that it's going to be a game changer for clients across the nation. I've done a lot of work to set myself up with the right people that are in the community that want to do good, that are doing good, that have done good, that have the right connections to keep building this community to the point where the VA loan and the community of veterans that serve it and the community of veterans that need us are just above reproach, and just, there's just not going to be anything out there like it. We're going to set the VA loan back up on a pedestal where it really does belong.
Right.
Awesome.
Thank you so much. Thank you so much. We appreciate it. We'll definitely be talking to you soon.
Indeed.
Thank you for coming on our show. Thank you so much. We appreciate you, Kevin.
Thank you. Appreciate it. Thanks for your time, guys.
All right. Have a good night.
Have a good night.
Wow, that was excellent.
The breadth and the depth of the knowledge that he has is just, anyone who gets him as a loan officer is pretty lucky. So veterans, it's Kevin Mitchell. He's going to leave his information. We've already put his information in the ticker.
Yep.
He's the one you want to talk to.
Absolutely. So as we get ready to close.
You can tell by this interview, he is the one.
As we get ready to close out, as always, we thank God for his unmerited, undeserving favor called grace. For grace is the total absence of any works. You can't work for grace. You can't buy grace. You can't sell it. It is simply what God has given to each and every one of us. Because we believe Christ died for our sins, he was buried, and he rose again the third day for our justification. On behalf of myself and my lovely wife, Melissa, and Contemporary Living, be blessed and have a great night.
See you next time.